To go. All right. Good evening, everyone, to our Torrance community. My name is Sheila Poisson, Finance Director of the City of Torrance. Just as a quick introduction, I've been in this position for 1 year now, with the city for 5, and practicing finance going on, 17 years now. I'm joined today by City Manager Aram Taparian, Assistant Finance Director Ian Daly, our lovely administrative assistant, Crystal Covaribis. She'll be here assisting with moderating the Q&A at the end of the presentation. And finally, apologies in advance, Dan, for butchering your last name. I believe it's Dan Metzweich with GovInvest Inc. Just this past year, we had partnered with GovInvest to implement a pension software solution as a tool to help us better forecast and manage future pension costs. And because of the complexity around pensions and investments and the significance it plays into the city's budget as a whole, the city manager and myself wanted to offer this workshop to the community as an option to learn about pensions in general and to be able to ask questions. At the end of the presentation, everyone will have an opportunity to submit their questions in the Q&A. I did receive some questions in advance, so I'll begin the Q&A portion with that. And then we'll kick it into the other questions, if any. I thank you all for being here. At this time, I'll turn it over to Dan, who will be kicking off the workshop tonight.
Thank you, Sheila, and good evening to everyone. I commend you for taking the time on any evening to spend time studying pensions. But as Sheila mentioned, they are can be impactful to any local agency, so it's important that they receive regular and appropriate attention. So with that, I will get into the presentation. We'll cover kind of 4 general areas: the pension basics, some hurdles and considerations that really all pension systems are faced with, and how your agency is doing relative to your funding targets. So as far as pension basics, there's a lot of pension jargon. I won't spend a whole lot of time here other than to note that we'll be talking a little bit about the discount rate, normal cost, and the amortization of the UAL. Pensions are really kind of laden with a lot of actuarial jargon. The discount rate is essentially the long-term assumed investment rate of return. And that's what's driving a lot of the commotion and drives a lot of the cost. The normal cost, you can think of that as your annual cost if all assumptions are exactly met. The amortization of the UAL, or the unfunded accrued liability, is in essence a self-correcting mechanism to recover shortfalls when actuarial assumptions are not exactly met or by experience. And the two together really make your annual required contributions. And I will leave it at that, not get into too much detail on the jargon. But if you're not familiar with CalPERS, most folks are but there is an important distinction. Some counties actually run their own pension system. CalPERS is considered a multi-employer pension plan administrator, and there's some economy of scale in order in having a multi-employer pension. That way, cities aren't determining their own benefits and having their own investment team, et cetera. And that could, depending on your perspective, could be a good or a bad thing. But in general, relative to other pension systems throughout the U.S., I think actually CalPERS does actually a pretty good job, especially when you look at pension systems throughout the country. And it's important to point out that they are the administrator, but the promised benefit is really made by and guaranteed by the city of Torrance. And due to the California rule with a defined benefit program, once that promised benefit is made, the benefit can only be changed prospectively per the California Constitution. And another common question that we get is can you exit CalPERS? Well, I guess the technical answer is yes. But it's not practical because the termination liability is cost prohibitive. And what I mean by termination liability is once a plan goes into a termination status, they can assume that there's no longer an opportunity for employers to true up when actual experience doesn't match up with the assumptions. So, namely in the investment earnings. Therefore, when a plan goes into termination status, the funds, the assets that are set aside to pay those long-term benefits are assumed to be earning at a blend of the 20, 10, and 30-year treasury. And it just becomes, as low as treasury rates are today and historically, it would be just astronomically expensive to exit the CalPERS system. So it's generally a non-starter, but that question, I wanted to address that head on because it is often asked. I think the California legislature, as well as city managers, have all realized that through the lens of today, that pension costs are extremely expensive, and therefore in 2013, actually 2012, the Public Employees Pension Reform Act was adopted by then or put into place by then Governor Gary Brown, and effective January 1, 2013, all public employees that weren't previously in the system would essentially receive a lower benefit with a number of provisions that will make pension costs in the future much more affordable and less apt to the large swings and fluctuations that we see in the current system. And we'll go over what some of those caveats or caps in the new plan are relative to the old benefit. And Torrance has 3 plans with CalPERS. They have a miscellaneous, a safety plan, safety police, and a safety fire plan. So when we look at the miscellaneous employee program, there's 3 benefits. There's tier 1, which are often referred to as classics. There was Torrance got ahead of it, and before the Pension Reform Act was implemented a second tier, what's referred to their 2010 tier, that lowered or increased the amount of employee contributions required for that plan. And then, of course, anyone hired after January 1, 2013 receive a lower benefit formula. You also notice that the final compensation is based on the average, the total of the average 33-year period or 36 months. So whether it's unintentional or even considered malicious pension spiking, much harder to do when it's over a 36-month period. And what that can often be referred to, or pension spiking is when during the final year, right, the city may be funding at a lower level, and then their final year of compensation, for very legitimate reasons, they may have received a COLA, they may have received a pay raise, but those, especially when the formula was based on the final 12 months, were looked at a very critical eye that possibly that was malicious pension spiking. Well, it's much harder to do with 36 months. And it's also important, not only is it a lower benefit, but the total amount of pensionable compensation for PEPRA employees are limited. So even if you had a highly compensated employee, potentially earning $150,000, $200,000 a year, if they're a PEPRA employee, their total compensation for those, since Torrance participates in Social Security, their total compensation would be capped at $134,974 for calendar year 2022. So that's all to say that no matter what happens, an individual can't receive pensionable compensation over that almost $135,000 limit, or that's the cap, if you will. And PEPRA also imposes by statute that the employees have to pay half the normal cost, no matter what that is. So if the normal cost moves up because they're expected to have less investment earnings, then the employees' share also go up as required by law. So the safety police and safety fire really kind of follow the same three-tier system. You notice since safety employees usually have a shorter work history, receive a higher benefit at an earlier age, but even the PEPRA tier, they receive a lower tiered benefit. Also subject to the 36-month and the compensation cap. But because they retire earlier, you can see their normal cost is much higher than the miscellaneous plans. So safety fire, really the same thing, just a slightly different costs associated with the fire employees. So what does a 2% or 3% at 55 actually mean? So in this particular example, this is a typical miscellaneous formula. 2% is the benefit factor if they retire at age 55. And so that benefit factor is multiplied times the number of years of service times that benefit factor or percentage to derive a percentage of their pensionable pay. So for example, if they worked 30 years, it'd be 30 times the benefit factor of 2%. And so they would receive 60% of whatever their, assuming, this is assuming final year or final 12 months, 60% of that compensation. And that's at age 55. Now, employees in the CalPERS system can retire as early as 50, but they will receive a reduced benefit factor. For example, they retired at age 54, the benefit factor would drop to 1.9% instead of 2%, and age 53, it drops to 1.7% and 1.6% at age 52, and so on. So when we look at the number of classic employees or number of employees by each of the tiers, at least in headcount, you can see that ratio is about 40% of the employees are already converted to the lower tiered benefit. But when we look at it in actual payroll, Pepper employees, typically younger employees earlier in their career, earning lower amounts of salary that you would expect on a percentage of payroll basis, they make up slightly, less than that 39%. So you can see there is really a good expected trend. So if folks expect, you can see the tier 1 represented in blue, the 2010 represented in black, and you can see it's a very steep runoff where the pension costs will come down as a percentage of payroll. And you can see that by 2048, 2049, you're almost expected to be 100% converted to PEPRA employees. And so I mentioned earlier that it's the total employer contribution is really made up of two components, both the normal cost and then that amortization of the unfunded actuarial amortization, unfunded actuarial liability. Those two components make up the total employer contribution. So there are a number of factors, both economic and demographics, that really drive the cost of or affordability of a pension plan, and inflation, investment, salary growth, and when we discussed before, if benefits are fixed by the California Constitution or the California rule, and investment income is lowered, it has a negative impact on employer contribution. So if there's less income to offset the cost of the program, then and the benefit cannot be changed, then the employee and employers pick up that additional cost. And therefore, and I'll show you on the next slide that the pension plans are extremely sensitive to investment income. So as we know, when we start funding for any retirement program, we want to start young. It's, as many investors will say, rolling a snowball down a hill. It starts small, and making those contributions over time will accumulate and compound and earn investment earnings. And so by retirement age, that investment earnings can represent something close to 2/3 of the overall cost of funding somebody's retirement. And so while their projected benefit at age 55 is measured by the actuaries, your unfunded liability is really the difference between here's how much we should have in the bank today in order to once we add future contributions and investment earnings, that it would grow to that desired funding goal. So your accrued liability is a picture point of time, and when investment earnings fall short of that accrued liability, then an unfunded liability is created. And it's important to note that neither the assets or the liability or the accrued liability, neither of them are recorded on the city's government-wide financial statements or their balance sheet. It is only when they are running short of their expected funding target. So it's only the unfunded component of the liability that is recorded as a liability to the city. Otherwise, both the assets are held in trust to pay for that promised benefit. So I think it's important to review some of the historical factors and look, to explain that really Torrance is really not alone in having this problem. So back in the late 90s, early 2000, there was Senate Bill SB 400 and AB 616 that enhanced benefits for public employees. And the rationale back then, keep in mind, this is late 90s, early 2000. We were going through the housing market boom. We had the dot-coms that were earning, had spectacular valuations, even though they didn't have much, hadn't even earned a profit in any particular year. So there was this tremendous wealth effect that was created, and the pension plans had the market value of the assets were 120% funded above the accrued liability. So they had assets in excess of their pension benefit obligation. And so it's easy to look in hindsight and say that, well, gosh, this was an incredible thing to do. But again, keep in mind, it was looking through the lens of the day. Of course, both labor groups and cities were really in this predicament because there was a pretty good spin to say, well, you can enhance benefits. Markets are producing extraordinary returns. They're going to keep on doing that, and so you could provide us this benefit for nearly nothing. And then once one city adopted it, then each city was in this conundrum of, well, if our neighboring city is offering this benefit, labor groups were very successful in making the argument that in order to attract, retain, and be competitive with our neighbors, we also need to provide similar benefits. And that is indeed what happened throughout California. These higher enhanced benefits that were offered through legislation were snapped up and adopted by almost every local agency throughout California. But as we know, the good times did not continue forever. There was the dot-com crash, the Great Recession, and then the capital markets really didn't cooperate. So over time, the funded ratio and investment earnings, and a lot of it driven based on the fixed income market, which we'll see later, fixed income has continued to be on a 40-year downward slide, and the funded status of the program of the system in total hit a low of about 61%, and generally thought once systems get down to about 50% funded, it's at a very critical status. Since then, the discount rate, or the assumed rate of earnings, has successfully been lowered again, all the way down to 7%, and as we'll see in the next slide, lowered again to 6.8%. And so while it's important to, it's good fortune, if you will, to say we had CalPERS had a very good year, 21% return. When you look back over history, 21% return, so any of these clusters of above average years are typically followed by below average years, which get us to the mean average expected return, which is that average rate of return. And this red line represents what experts expected that the capital markets would deliver, and you can see that rate of return is earned through a series of good years and then lower years, and there's always the reversion to this mean average. But when you look at the returns over over a 20-year period, even today, you could see that they earned well below the discount rates that were being charged at the time. So it started out at 8.75%, but if they only realized a 6.9% return, there was a good stretch of time where they were undercharging essentially for this benefit, and hence there's been this constant downward pressure to reduce the discount rate or the assumed earnings rate to something that people consider reasonable. And what's driving that, I mentioned this to you earlier, is that the treasury rates or fixed income in total have been on a 40-year slide, hit a low of about 55 basis points, less, so it's almost half of 1% the summer of 2020. And so for that reason, CalPERS readily admits that they needed to take on more risk in order to achieve the returns. Well, meanwhile, conversely, the former chief actuary, Alan Milligan, in 2015 was getting complaints from member agencies that there was so much volatility in rates, and there was risk of underfunding the program. So he came up and proposed a risk mitigation policy that said, okay, we want to remove some of the risk from the investment portfolio. So in the good years when we earn exceptional returns, set up a formula in which if the expected return was 7% and they actually earned 21.3%, that means they beat the return. They had excess return of 14.3%, thereby triggering a reduction to the assumed rate of return. And the theory was they could remove some of the risk off the table. Unfortunately, as I said, the capital markets haven't been all that cooperative. And so while it's been effective at lowering the discount rate, the policy has not been effective at reducing the amount of risk in the portfolio. And as some of the other slides showed, they're actually having to take on more risk just to even scratch back up to 6.8%. And so as part of their once every year process, 4-year study of, it's called an experience study, or it's often called the Asset Liability Management System, or ALM, where they review some of those, all the economic and demographic assumptions. And as I said, since it's investment return is such a key component, they spend a lot of time looking at what the capital markets could bear. And their previous portfolio that was in place through June 30th of 21, when they surveyed all the big banks and the big investment advisors, that advise the big pension programs like Makita and Wilshire, and the big banks like JP Morgan Chase, Goldman Sachs, JP Morgan Chase, came back with a expectation that their current portfolio in the next 10 years would only earn 5.3, and over a 20-year would only earn 6.2%. So early in this year, I think most cities were rightfully so nervous that CalPERS would lower the discount rate as far as 6.25%, or something close to that. But the board actually pushed back and said, no, while we have a mandate to make sure we can continue to provide benefits, we also have a mandate to try to keep costs as low as possible. So they directed staff to come back with portfolios that would support both a 6.5% discount rate and a 6.8% discount rate. And that is ultimately what they decided. They picked an investment portfolio that would support 6.8%, which involves increasing additional risk, additional exposure to private equity, some additional leverage. And then they changed a number of other assumptions. It's hard to explain why they reduced the inflation assumption, but looking back over the past 10 years, inflation is true. Inflation has been running lower, and the chief actuary said just looking at a long-term view, he thought 2.3% was appropriate given how the experience looking at the past. However, I think most people find this to be a questionable assumption. But they also increased the wage growth assumption going the other way, which going from 2.75% to 2.8%. And then there were another, as I mentioned, there are a number of other demographic assumptions, including mortality, and wage growth, and in total, these demographic assumptions are, there were some going up, some going down. For most agencies, it stayed fairly neutral. So I'm not expecting that these other demographic assumptions will have an impact to the program, but it may change our estimate by a percent or two once you roll in some of these other factors. So when will this happen? So the board adopted the new discount rate sort of in November, and it's in essence retroactive to June 30th of 21. And what that will mean is, so in the most current valuation that we have is really June 30th of 20. So the actuarial valuations lag significantly. So the June 30th 21 valuation that will be received in July of 22 will impact contribution rates for 23-24. But you will exceed in July of 22, when you receive that valuation, your funded status will go up significantly as a result of that 21% return, even after considering the offset for the lower discount rate. So let's take a look at how these things impacted the city of Torrance. And so what you up until for the June 30th valuation was already funded at 91% funding, and just by so if you recall, the city issued bonds in order to bolster that funded status and take advantage of, in essence, very cheap money, borrowed it, and that money has significantly improved the funded status. But they did so in a measured way. It's exactly what I would recommend. You don't typically want to issue pension obligation bonds up to 100%, because you don't really know what's around the corner. And indeed, CalPERS earned 21%. So the timing was fantastic. And you could see if it were just the 21% return by itself, it'd be right about 101% funded for the year. Because looking at it in isolation, just the investment return, not changing the assumption, you could see it dramatically improve the market value of assets, and the bond proceeds also benefited from that 21% return. So the timing was spectacular. They got the city to 101%. And now, after reducing the discount rate, you could see assets stay the same, but the accrued liability goes up slightly because there's an expectation that you would have less investment earnings with a lower assumed rate of return. And you can see we had options all the way down to 6%, showing what impact that would have for the city. The most recent valuation would show a funded status of 91%, but when you receive your valuation in July, I fully expect that your funded status will be very close, if not at 100% funded through as of the 6/30 valuation date. So let's take a look at kind of how that plays out. So you can see this is the orange represents the total normal cost, which is paid for by both employees and employers. And you can see effective 23-24, there's a slight uptick in that cost. But you can see the trend is actually declining. And the trend is declining because you're replacing those classic or higher benefited employees with PEPRA employees. So you're going to see your costs over time, the normal costs coming down and settling to the really the cost of a PEPRA employee. When we look, and so here's another look at it, you can see that normal costs will increase by about $1 million per year starting in 23-24. But your annual amortization payments will come way down. So in effect, Torrance will start in 23-24, seeing a dramatic reduction to its payments. Well, I take that back. Torrance is an unusual situation where it essentially doesn't have much in the way of an unfunded liability payment. So we'll see an increase. You'll have one more year of unfunded liability amortization payments in the current year, and then they should go down to zero. And the big caveat there is if and only if CalPERS earns no more, no less than 6.8%. So, we see it's about $1 million increase as resulting from that lowered assumed investment earnings rate. And so when we take a look at where the costs were, so this would be post bond issuance, their unfunded accrued liability contribution, they still had some, they're only at 91% funded, so they still had some funds yet to pay off. And it was structured in a way that it was fairly level. So it was nicely done. Now with the 21% return, we can see that their unfunded liability contribution is going to go down to zero very, very quickly. And the green represents the little bit of a unfunded liability payment associated with the reduced discount rate. But you can see it's coming down dramatically as a result. And what I demonstrated here, excuse me, the green line actually represents if they earned so they had the discount rate at 6.8%, but actually only earned 6.2. So therefore, you could see it didn't go to zero. Because you're assuming that in the future you would only earn 6.2%, that your cost would start trailing up until that unfunded liability is paid off. If you drop that rate to that, if you kept the portfolio the way it was, so you kept the discount rate at 6.8, but if they only realize a 5.3% return, then over time your costs would be much higher had they not change the portfolio to hopefully earn 6.8. But we do have to recognize that with a big run up in the market at 21%, that there will be likely over this next 10-year cycle, that there will be years that will fall below the expected return of even at 6.8%. And you would expect some costs to actually go back up. These are pretty extreme situations. These were essentially assumed forever, but you could see how investment earnings make a dramatic impact. When we look at the total employer contribution, which includes both the normal costs and the UAL, you could see what the costs look like prior to, after the bonds, but prior to the 21% return. And then you could see that the normal cost starts to drift down to a more sustainable employer contribution. But if investment returns actual experience is only 6.2%, you can see the costs start creeping up again. And the same is true at 5.3%. That's when you can see, well, okay, that's changes would need to be made in order to keep the plan sustainable. But this is part of the sensitivity analysis, because essentially you can't assume that the good times will continue on forever. So it's important to look to say, okay, well, things are good now. Things could change pretty quickly. So it's often it's recommended. Tell my clients to when things are good, it's a good time to consider replenishing reserves or preparing for the next downturn, because while costs are on a downswing, certainly there will be some periods where they'll underperform and have additional costs. So that's the end of my presentation. And with that, I'll turn it over to Sheila to go through a number of questions that I see are queuing up.
Thank you, Dan. Let me go ahead. If during this time, please go ahead and submit your questions in the Q&A. I do see some questions in the chat as well, so we'll make sure to address those. I'll go ahead and start off with the questions that were submitted by one of our residents, Mr. Mario Bejas. The first being, his first question: most employers today limit accumulation of paid time off, i.e. vacation days, sick leave, etc., with use it or lose it policies. E.g., no one can accumulate more vacation days than a year and a half worth. It's my understanding that Torrance does not limit accumulation of paid vacation days by full-time employees. Is that correct? The answer is, for the most part, full-time employees are limited to 1,000 hours of time off, 500 hours of sick, 500 hours of vacation. In any given year, when an employee reaches that limit, they have the option to cash out these hours that have been unused. There are limits to how much an employee can cash out per year as well, but they do vary by labor group. Second question from Mr. Obejas, when accumulation of paid time off is not prohibited, such sums become stealth investment vehicles growing at the same rate as annual wage growth, e.g. 2 to 5% annual growth. Torrance full-time employees can request cash outs of a portion of their accumulated paid time off at the then prevailing wage rate, i.e. a higher wage rate than when they were earned. Is that correct? The answer, yes. When an employee requests a cash out, it is paid at the rate the employee makes at the time of cash out, not exactly the rate of when the time off was earned. The third question, when pensions are based on the highest years of compensation, there is incentive for pension spiking. Cash outs of accumulated paid time off affect an individual's pension formula by sometimes dramatically increasing their compensation amounts. This appears to be why the most well-compensated full-time Torrance employees have a markedly higher other compensation value in their transparent California other pay amounts, significantly higher than comparable cities like Glendale, Pasadena, and Inglewood. I'll take this question in kind of two parts. It was a long question. The first part regarding the highest year of compensation. This is true for classic employees, those that were hired prior to January 2013. These are the employees that are considered classic members, and these members will retain the same benefits as was obligated upon their hire. However, as Dan had mentioned in his presentation, as part of pension reform, those employees that were hired after January 13th, who we refer to as PEPRA employees, they have a cap on their pensionable compensation of roughly $126,000. So that addresses the possibility of pension spiking. And then to address the second portion of the question, yes, cash outs are reported as other pay or other compensation on the Transparent California website, which is why upon retirement, those that cashed out their available hours appear significantly higher paid. But to also clarify, these, what we're referring to as cash outs or unused vacation hours, are not counted towards pensionable compensation as base pay and premiums are. And the last question from Mr. Obejas was that the most recent assessment by state financial auditors put Torrance as the fourth riskiest city out of 482 California cities. What mitigations or improvements are either planned in the next 12 months or already implemented in response to the low state rankings? This is a good question. For those that haven't seen, yes, Torrance was placed fourth on the state auditor's high risk financial ranking. It's a 100-point ranking system with the categories being pension, general fund reserve, debt burden, liquidity, and revenue trend. And where Torrance ranks the lowest is in the pension categories, general fund reserve, and liquidity. So that makes up 80 points of the 100. So for that reason, we're focusing on those three, the categories pension, general fund reserve, and liquidity over the next several years. In the last 2 years, I will mention one-time mitigations that we have implemented. Not only did we do the 2020 lease revenue bonds to pay down our unfunded liability that saves us about $6 to $8 million a year. We also refunded one of our other COPs that saved us $3.5 million between fiscal 21 and 22. We had closed out some capital projects in the amount of $4.2 million to rebuild our reserve balance. And then we also had transferred from transit the remaining portion of their portion of the regional transit center also to rebuild our reserves. So I say rebuild reserves because at the time that we were placed fourth on the list, our general fund reserves were at $600,000, and we've been over the last 2 years been holding vacancies, implementing other items, which I will mention, to build that back up. And as communicated in our first quarter, we are anticipating, notwithstanding any large litigation or unforeseen disasters to build that up to 24 million by the end of this year. Although I realize those, what I just listed, those are one-time costs. So really we need to be focusing on recurring. So what types of savings can we anticipate or revenue generation moving forward? So in fiscal 21, I already mentioned the lease revenue bonds. We had done department reductions, budget reductions in the amount of $6 million. Last year, the fire department implemented the emergency medical transport system. So we previously fully contracted that out to McCormick. We brought that in-house. That was a revenue generation of about 2.3 million, and that so far has been very successful. We implemented enterprise fund franchise fees of 1.2 million every year. We did a citywide fee study to increase our cost recovery levels for services that we already provide. That's anticipated to bring in additional $570,000 a year in revenues. And then again, this past October, we had done a second round of reductions in our department budgets and police department civilianization conversions of about $6 million then. So those are the areas that we have already made reductions in or generated revenue and cost recovery. Moving forward, the focus will be to rebuild our reserves. Again, as I had mentioned, where we have 0 points are in general fund reserves and liquidity. So we'll continue to rebuild what we call economic anomaly. A litigation reserve is also another reserve I'd like to establish, and should our budget and our actuals allow us to, we can build that. And then lastly, a pension rate stabilization fund. We had opened a Section 115 trust back in June 2021. So we did make our first contribution to that to mitigate, I guess I should say, significant and sudden impacts to our budget should CalPERS reduce the discount rate again. Those are the 4 questions from Mr. Ovejas, and if we could also move into looking at the questions from other attendees.
Good evening, everyone. So I will start with the questions that were in the chat first. The questions come from Mark, asking if this funding level for 2020 is this the funding level for fiscal year 2020-2021 only, or for the entire pension portfolio? I'm not sure what slide they may have been.
You may want to bring up the slide, Sheila or Crystal.
I believe it was before that slide.
That's the one. One more forward.
I think it was that.
Oh, listen.
This one.
Okay, so the increase to the normal, so this is the normal cost. You can see in 23-24, it jumps up, but every year thereafter, you can see it's actually on a decline as you transition from the higher benefit, higher tiered employees to Pepper employees. And that's going out to, 2045, 46.
Dan, it looks like he's referencing the grid table. That was the slide after this. Yeah, that one. Oh, that one.
This one?
Yes. But there's one clarification that this is Torrance's own assets and liabilities, not citywide or not CalPERS wide.
Yeah, this is Torrance. So, and option B is, since we didn't know at the time, this was evolving, we measured the liability under 4 different discount rates, highlighted in green. That's showing 21% return, your assets of $1.7 billion, and an accrued liability of of the same. And you're showing you're close to 100% funded. But that's a snapshot in time. That's a balance sheet measurement.
Is this for fiscal year 2021 only or in aggregate is the question.
Well, it's cumulative through June 30th, 21.
Okay. And then the second question from Mark as well on total contribution. Shouldn't we be showing the bond payments as well?
Absolutely, that is one way to look at it. Traditionally, in financial statements, your hard debt is separated from your operating liabilities, and that's a convention. But for the purpose of this, we could have, to your point, showed the two together to show, and perhaps the original, which could show the net savings, but that was an oversight on my part. But good point.
Allow me to add as well, Dan, for this question, that the charts that were put together for this presentation and what the attendees see here, they were built in the GovInvest tool. And they were built with the understanding that the assets that are listed in the tool are highly sensitive and will fluctuate with whatever the assumptions are, whereas the debt service is already prescribed, and we know what that is every year for the next, I think it's 2043, I believe. So we can absolutely incorporate it into a chart, but it wouldn't be included in as part of adjustments relating to the sensitivity of the investments. Just to give an idea of what the payments are for the debt service, it varies every year for the next 10 years between $16 to $18 million. And the increase every year or fluctuation is anywhere between an increase of 400,000 to 500,000 per year, as opposed to if they were in a CalPERS investment that can fluctuate millions of dollars up and down. Hope that helped.
Okay, and then moving over to the Q&A portion. This first question is from John. Given that CalPERS has a 20-year history of overpromising and underperforming, how can the city hedge for the eventual downturn?
Well, if I could start and then Sheila finish. That's exactly the purpose of the city's Section 115 plan. So put money aside and when times are good. And the benefit of the Section 115 plan is any money in the city's coffers are heavily restricted by California Government Code 53601, which restricts investments to treasuries, agencies, and other fixed income instruments that are yielding a very low yield. And after considering inflation, those really have a negative real rate of return. So the city's losing purchasing power by leaving it in their coffers. By putting it in the Section 115 plan, they're able to invest in assets that will keep pace with inflation.
Thank you, Dan.
We'll also add to just one quick thing. If you recall, Dan had shared this slide earlier in his presentation. Understanding that concern, in our 10-year forecast, we actually utilize these estimates from CalPERS, in which in our 10-year forecast, we don't build in and expect that CalPERS will actually return 6.8%, but between 5.3 and 6.2. A more what we feel realistic return. Thanks, Dan.
Okay, thank you, Sheila. Thank you, Dan. The next question from Mario looks like we actually answered it. He said, thank you, you answered my question. And then from Mark, How does Torrance's total pension debt compare per capita to similar cities with bonds?
That's a good question. I don't know that off the top of my head. I'd have to do a survey, a comparison of all cities and really dig into their financials. But I do know that several cities, we did look at a survey of what their pension costs were. And I want to say over 20 of them, and Dan, you can correct me if I'm wrong here, at least in Southern California that I looked at, had issued POBs like us as well.
Yeah, it's without doing that survey, I don't know the debt per capita, but having I'll just tell you I'm a little bit cynical and skeptical of debt per capita because it doesn't so your population isn't always a good measure of your revenue capability. And so not to say how that would skew one way or the other, but I would look at it in terms of your more of a debt to income and your capacity. But to answer your question, I don't know how Torrance compares to other agencies in that metric.
Thank you. Next question from Anonymous. Hello. Would it be wise to start a pension in California if one only plans on living in the state for 4 to 6 years? Also, if you could please give a pension 101 overview to a young adult that's new to all of this. Guess that might be a request. And then from Cliff Newmark, is it possible on a consistent basis to show the forecast for total pension expenses annually to include the bond payments and these CalPERS forecasts? It would be helpful for the public to understand the overall trend, inclusive of both factors, as they go to the same issue, retirement expenses.
Sure, and we have the capability to layer those two together. So it could be done outside of the software or in the software, but we're happy to do that either way.
We will update the two, consolidate and post it to the public as well. So we can show the totality of the impact from the CalPERS assumptions, as well as the lease revenue bond payments. That's a great recommendation and suggestion. Thank you.
Okay, and then I'm going to jump over to the chat. Looks like there's some questions here. So from Will, what is the city of Torrance's current funded ratio? Is it 91% right now? In an earlier slide, it said 70% as of 2017. If it is indeed 91% funded, that looks pretty good, which seems contrary to California Auditor website, which mentioned Torrance is the 4th worst city in California.
So the 630 funded status, 630 of 20. I don't know how I'm sure that website is out of date, but keep in mind the 91% status is as of June 30th, 20, and that includes the benefit of the proceeds of the bond issuance, bringing it up to 91%. That's as of 20, and the projection for 630-21, even though that valuation isn't out, is that you'll be very close to 100% funded on your pension.
I will say it is unclear to me how much that would improve our standing and how many points we'll gain because we did have to borrow the lease revenue bonds to pay that off. And the category also includes pension related debt. So although I do know it'll improve our status, I don't know by how many points. So over time, as you can see, as our employee base shifts from classic to PEPRA, I think at that point is when it will really impact and will really improve our status. But that's a long-term play.
All right, thank you. And then here, let's see, I saw from John, the 350 million street bond issue is collateralized by non-revenue generating assets. Are bond interest payments built into the annual budget? Under what line item?
Yes, they are in the budget. They are under specifically, and you can find this in OpenGov, under salaries / benefit - PERS. You'll see two accounts for lease revenue bonds miscellaneous and lease revenue bonds safety. Roughly $16 million for FY 21-22 and 16.8 in 22-23.
Okay, thank you, Sheila. And then a question from Will. If the financial situation for Torrance continues on a downward trajectory and the sales tax measure doesn't pass, what will happen to city employees and services? Will there be additional 5% reduction in staffing? Will pension benefits be reduced for current employees or new employees only?
This question really remains as a dependent on what city council decides to do. So in terms of timeline, you'd mentioned here the sales tax measure. We're currently undergoing a survey poll of likely voters to see whether or not a potential tax measure is.
Sheila, your mic was dropped
Yeah.
off. We apologize for the technical difficulty. As Sheila was mentioning, currently
Yep.
we're in the process of conducting a survey of likely voters. And based on the survey, we'll share the results with the community. And at that point, council will decide whether or not to place the measure for public consideration on the June 7th ballot. In regards to the additional cuts, the current budget scenario does project a 5% reduction we implemented for non-public safety. Public safety was in abeyance pending the outcome of the sales tax. In regards to the benefits, as Dan mentioned earlier, we cannot reduce the pension plans under the California rule. However, we may be challenged to provide future pay adjustments via negotiated contracts through collective bargaining, since lack of funding will hinder our ability to commit future contributions. If that answers your question, Will.
Thank you, Aram. Okay, jumping back over to the Q&A. Mark submitted a question. So he states, we aren't hearing a lot of changes to improve labor efficiency, i.e. Torrance is one of the few cities I see where 2 ambulances or paramedic vehicles respond to almost all incidents. I'm sure you are looking at these. Can they be discussed? And then he also mentions, we also have many low paid and extremely high paid city staff. We're well out of the norm for this.
In regards to the first piece, our ambulance transport model is consistent with LA County regulations. There's a distinction between the actual ambulance operators. This was the same model that we're using prior to Torrance, transferring from private operator, i.e. McCormick, to the city transport. We have a paramedic engine company that accompanies the rescue, which is the paramedics. And then depending on the nature of the call, we're able to then send the ambulance to the hospital and free our unit back to service. So that's consistent. It's not different in Torrance than any other city that provides its own ambulance transport. And in regards to the low paid and extremely high paid city staff, we are a full service city that has tenured employees, and as such, those are negotiated contract raises. We also have a merit pool for executive and management. So we'll have to do a more of a deeper dive as far as how Torrance compares to other agencies. I was sharing with the city finance director, cities over similar size, Glendale, Burbank, Pasadena, Santa Monica, as I've mentioned in the past. Torrance is fairly consistent with the number of employees. We do have a larger payroll, and that can just be in regards to a more tenured employee base, which one can say maybe a plus given the time employees stay here. As far as the entry level, we are sensitive to market conditions, and right now we're in a very competitive market, and as such, we're having challenges in recruiting employees for some of our more entry-level positions, and we had to go and adjust pay steps as to attract employees, especially in hard-to-fill positions like water operations, some in the sanitation department with refuse, as well as in a fire service, because many agencies, as our chief has said, are in a hiring mode now, and there's lack of the qualified candidates to attract.
Thank you, Aram.
You.
This question is from Roxanne. So she says, this may have been covered in a slide, so I apologize in advance if I missed it. As of the last UAL calculation, what is the actual financial liability or dollar liability?
So at 6/30/20, so this is prior to the 21% return. It was roughly 160 million. Our projection with the 21% return net of the small UAL that's created by lowering the discount rate, we would anticipate that your unfunded liability is less than 20 million at this point.
Thank you, Dan. Switching back to the chat from Trisha Blanco. Is police overtime pay included in figuring out how much retirement a person gets? Would TPD save money by hiring more officers and thus allocating less overtime?
No, overtime is not pensionable, it's not personable. Sometimes it's more advantageous to pay overtime, because for every hour worked, we pay the cost of pensions and benefits. However, in the current state of affairs, our police officers are significantly on the strain given the significant number of vacancies that we have in the department. But ideally, we would fill those positions. Like all other agencies, we're struggling now with hiring police officers. So the officers that are here, they're carrying a significant burden by working additional shifts and overtime. But that overtime is not pensionable.
Thank you, Aram. And we have another question from John. The state of California generated a $31 billion surplus in fiscal year 21-22. Has Torrance also experienced an increase in sales tax and property tax revenues in addition to federal COVID funds of $22 million in 21-22?
I'll ask Ian to give us a little update on the sales tax. We have seen a slight increase, which is welcome given and we think it's attributed to the pent-up demand as a result of the last year's closures. We're not sure if that'll be sustainable. One point of clarification, the American Recovery Act was 24 million over 2 years, and that funding will run out end of fiscal year 23, which is in July of next year. Ian, if there's anything you want to add on the sales tax.
Sure. I mean, I guess the one thing I would add is, as you've indicated, sales tax revenue and property tax revenues have bounced back a bit. But when we closed fiscal year 21, our situation improved really just because of one-time things that Sheila identified earlier. So we are definitely not in a similar position than that of the state of California in generating that level of surplus.
And one more thing, the property tax, even though, as Ian said, we've experienced an increase with this current market, it yields a significantly smaller impact to the city of Torrance versus the sales tax, because majority of the property tax goes to the schools and the county.
If I could add to that, can you guys hear me?
He's
on the-
back. Yes, we can.
I'm here.
All right.
Okay. I invite you to take a look also, I believe it was Mr. that had asked this question. During our first quarter, we did present what our results and anticipated results. And as Mr. Daly had mentioned, we did, looking like we're bouncing back this year. However, we did receive a updated 5-year forecast from our consultants, our sales tax consultants, and they anticipated that last year and this year, there was a significant pent-up. Following years after that, they're anticipating annual increase of roughly 3% from. So we will use those as a basis for our forecast going. Our property tax has been fairly healthy over the last years, and we continue to see that. We're seeing it was between 4 to 5%. The reason why I invite you to look at our first quarter is because in our first quarter, we also addressed other areas of concerns that the city is facing, that even these improved revenues would be utilized. Oh, there's also one thing I wanted to mention. A couple questions back when there's several questions around police and fire. We did do a quick survey of cities of our size. You know, how do we stack up compared to the other LA County cities between a population of 100,000 and 200,000? We really can only compare ourselves to Pasadena, Glendale, and Burbank, because we found most of the other 7 cities contract with the county for those services. So for those that do have their public safety in, just a couple notes. So for Pasadena in police, in terms of police FT count per 1,000 population, Pasadena is 1.6, Glendale is 1.2, Torrance is 1.5, and Burbank is 1. Police budget per resident, Pasadena is $616 per resident. Glendale at $491, Torrance at $604, and Burbank at $590. On the fire side, similar types of comparisons. Fire budget per resident for Pasadena, $381, Glendale, $333, Torrance, $346, and Burbank, $360. In terms of FTE count per 1,000, Pasadena's at 1.1, Glendale at 0.8, Torrance 1.0, and Burbank 1.2. Kind of that high level survey that appears that we're fairly comparable.
We've lost you, Sheila.
Bill?
It just cuts out a little bit. Like that was a little run there.
Ah, shoot, sorry. Well, there's only so much I.
Okay, and it looks like we have one follow-up question from Mario. So if the city is in dire financial straits, it still seems top heavy compared to Burbank, Pasadena, Glendale, etc., comparable cities with their own fire departments. Case in point, we have 6 full-time fire battalion chief managers averaging close to $500K full compensation in 2019. That's a lot of chiefs, not enough not chiefs. Seems like a lot. Can't we get by with fewer and perhaps hire more paramedics instead? We see promotions and they seem out of sync with the city's financial condition.
Yeah, I think the chief has made recommendations to provide services to the community. The pay and benefits are consistent with industry for the position and the scope of work. These chiefs work a hybrid schedule, and they cover, they're on call 7 days a week. And as I said, they're consistent with the needs of the department. We continues. We do have a change in the longevity that's offered to new chiefs from the current from the prior contract, which was 34%. It was reduced to 24, and that'll start showing up in a few years as the new chiefs retire. But again, these are highly specialized positions in the fire service. These are managers who are capable of covering operations, and I'll just leave it at that.
I have two things to also add. It's important to look at apples to apples comparisons. I don't have that analysis that we had done related to this in front of me, but some cities, well, most don't include unfunded actuarial liability payments in their reporting to the state controller's office, and therefore Transparent California. Torrance switched in 2020 to exclude that, which gets us more in line with what other cities do. So if we're looking at 2019, we have a bit of an apples and oranges comparison. And another piece that plays into this, I don't know if those fire departments participate in this, but our battalion chiefs can get sent on some of the major fires in the state. And when sent on that generates an additional cost to the city to pay, though it is reimbursed by Cal OES. So just a couple important points I wanted to add in there.
And I encourage any one of you who wants to learn more about fire service and TFD to please reach out to Chief Cerna. He'll be more than happy to schedule a Zoom and give you a breakdown of fire service and the full scope of what we provide and answer any specific questions you may have. Thank you.
I see no additional questions in the chat or the Q&A at this time.
Hear me now?
Yes.
We got it. We got you.
My gosh, I apologize for the audio issues. I'm on the phone right now, but just coming from myself, I wanted to thank everyone that taking the time out of their own personal time to be here and educate themselves. Mention the basics and situation, but this has been recorded. I will post it on the website as well, and also be able to provide this.
And
Thank you to Dan and Gov Invest as well.
thank you, Dan. Sheila, thank you for organizing. Crystal and Ian, thank you to our community for indulging us on National Championship Football Night. As Sheila mentioned, we'll post this information online. We'll fix our mics in time for the next webinar, which is in regards to our budget update and an overview of the sales tax potential ballot measure. Again, please reach out to us anytime. We hope to make this an annual update to the community. As a recap, we will go ahead and merge the unfunded liability through the lease revenue bonds and share the information with all of you. Please follow our social media posts for any other updates. Stay safe and reach out to us anytime with your questions. Have a nice evening, everyone. Thank you.
Public workshop. I make my plug.